I'm with Courtiers Asset Management Director Jake Reynolds, and today we have some news to announce. Jake, what is it?
So we've won another award. We've won the best fund over 10 years for the Growth Fund, judged by LSEG, by the Lipper Fund Awards. It's our 16th over the lifetime of the fund, and also in that period we've been shortlisted for Fund Manager of the Year
16
5 times.
10 years. If it was anything else, I'd ask you, are you getting bored now? 10 years award, that's not your only 10-year award, is it? So we're talking about consistent performance, but awards have been...
The award itself is on consistent returns, so they don't just go 10 year, who did that? Because someone might have just taken one massive bet, got paid off. So they look at, you have to be consistent in non-overlapping periods. So you've got to be good repetitively. And not only is that proof of the award, but also the fact that this is the 5th time we've won 10-year returns. We've also won 5 and 3 year. Yeah. The 5th time we've run 10-year on multiple funds. But you've got to be the best fund in that sector, in your peer group, to do that. So it's a real honour to get this award. Really pleased.
Oh, well done, Jake, to you and the whole team.
Well, yeah, we have to thank everyone, not just the investment team, but also everyone that, the investment fund accounting. Every one of these funds is a company, and it has its own board, and it has its own bank accounts, it has its own custodian, its own depository, which is like the people that will overlook us, our compliance teams. You've got to say thanks to. It's a huge operation, and then to our advisors as well, and then on the wealth management side, and ultimately the most important thing is the clients, because without the clients we don't manage any money, you can't win any awards. And as Sam Walton said, the founder of Walmart, customer is the only boss. They have the power to sack everyone here just by shopping somewhere else. So they're not shopping at Courtiers. Oh, I guess they are really when you invest in your shopping. But thank you for investing with us, because that gives us the opportunity to manage your money responsibly and win these awards.
Well done, Jay. Very grounded. So to be clear, this is an LSEG, which is London Stock Exchange Group, Lipper Fund Award. Now, this outfit describes itself as reflecting a truly independent and uncompromised assessment of performance in over 19 countries worldwide. Right now, we're talking about the United Kingdom specifically. The legacy of LSEG is underpinned by LSEG Lipper's acclaimed fund data and proprietary quantitative methodology. Can you explain to us what that means in simple terms?
Yeah, well, the way that they do it is purely quantitative. There is no conflict of interest. They're purely independent. So it's someone just looking at the whole market and going, these guys are doing it right.
Numbers.
So it's really nice to get them right. And it's numbers. Yeah, exactly. This is with the Fund Manager of the Year, you get shortlisted on your numbers. But to win it, you have to write a nice story, and obviously that maybe I've fallen short of writing. I wrote the story in 2023, and we never quite nailed it. But to get on that shortlist was such an honour, because you quantitatively you're there, and in those years we were getting lots of Lipper awards as well, so we knew we were like the top one, but didn't quite nail the narrative on to impress the judges. But I mean, like I say, it's great to just be on that shortlist 5 times and win these Lipper Awards 16 times.
Why don't we let the world do the narrative? 10 years. What have we been through?
Wow, it is. So, I think this really proves what we talk about, the long-term power of equities, because the Growth Fund is the only completely unconstrained fund, mixed asset. The group that we're in is mixed asset flexible. It means GBP. You can do everything. Yeah, it's priced in pounds. So against other UK platforms. So what does that mean? It's the only fund that can hold up to 100% equities. Everything else is in the multi-asset space is the Balanced Fund and the Courtiers Fund is scaled down. So this is our unbridled opinion, and we scale that down in the other funds. So this shows that we're doing our equity right. And we talk about those at the seminars, the 10% return, getting a real return of 6 to 7%, doubling your money in real terms. And this is exactly what the fund has done over the last 10 years. So to Friday close, from the period that this period began, this fund has done 9.89% per annum after
on average.
Costs. On average, that adds up to 164% return. Inflation has been about 3.4, so you're up like 90% in real terms. So your money has 90% more power just by sitting and being a client. So I think it's great that you can compound at a really significant real rate of return using equities, and you can access that via the Growth Fund, and we'll deliver it at considerably less risk than just buying one market. This fund has outperformed the FTSE 100 with a lot less volatility.
That's important as well, the volatility. How smooth the ride is.
Yeah, exactly. Because, we looked at those markets in December. We said from 1972 that pretty much all markets end up in the same place, 10% return. But ultimately their journey is completely different. And if you just invested in one, you wouldn't get there. And that's why this board for consistent returns is so important, because if you just invest in one, you wouldn't get consistent returns, because you would have periods where you were down a lot, because a lot has happened over those years, and the fund has seen through them.
Jake, just on that point, the funds go down. Significant global events spook the markets, they go down. You and I were talking earlier. You call this drawdown.
Yes.
When the markets dip because of what's going on in the world. You mentioned that since, was it the early 70s?
Yeah.
These significant events affecting markets have become more frequent, but the drawdown has become
I think the
lower.
charts,
they're not getting as spooked.
Yeah, I think since 2000, we had two big ones, 2000 and 2008. They're two big ones after the ones in the 70s. But nowadays you're getting more frequent 10% drawdowns, which is interesting, but not as bad. But can I just go through what these funds have been through for 10 years?
Yes, please. Yeah.
So, you've had the European debt crisis, you've had China hard landing, US debt downgrade, Brexit, COVID, Russia, Ukraine, whatever you want to call what's going on now, third Gulf War, whatever you're going to call it, and a multitude of other scares, like tariffs, US slowdown in 2024, and then 2023 we had SVB, the US regional bank blow up. So this fund has seen through all of that and delivered that return despite the risk.
So if the drawdowns are gradually lower over time, does that make your job easier in the investment team?
No, it means it's more. I don't know. I don't know what's easier.
That might be a silly question. They're not going to drop as much.
Yeah, I think it's just.
They'll recover.
I think COVID has created a lot of downstream issues, and I think some stuff is tied into that. So I think that's why there's been a bit more frequent events, and then you've had but a lot of inflation shocks. I was looking just to get these, 9.89 return. Inflation's been 3.4. You've done a 6.5% real return on this fund over the last 10 years, and that's really powerful. And if you compound that over 30, 40 years, it's life-changing sums of money. But inflation has been 3.4. The 10 years preceding that, it was only 2.5%. And that's a big difference, 2.5% per annum. You really feel that. And that's because we've had these supply shocks, post-COVID supply shock, Russia-Ukraine supply shock, and now this oil supply shock. So inflation has stayed persistently high, and people might be getting ready for a higher inflationary world. I don't know what's easier, more frequent events. So we have something every year where we're getting on camera going, we're diversified and we're looking at it and we're making any appropriate action, or we do have 3 years off, not 3 years off, but 3 years of calm and then a massive 2008. Or I think probably you'd have to ask Gary, because I started my career in 2008. That's all I knew at the beginning.
Yeah.
So it's really hard for me. That would be a good question for him, because he's seen it all in terms of big drawdowns versus lots of little drawdowns.
Well, good. I will park that up and ask Gary.
Yeah.
Now, almost a year to the day, 21st of April 2023. Not a year to the day, sorry, 3 years to the day. 21st of April 2023, we reported bagging 6 more of these awards. And at the time, Gary drew an analogy between Courtiers' value approach and running a marathon, saying you have to pace yourself.
Yeah.
Now, what I want to ask you is running a sprint and running a marathon, get it, pace yourself. What's the training program look like?
Yeah. You've got to, you've got to look at the long term. That's the training. Train yourself on the long term, put things in perspective. There's this thing called base rates, where you look at how frequent this has happened in the past and then draw parables of that. And I think that prepares you to make sure that you can keep. A lot of the things, a lot of what we've done, and the reason we've won a lot of awards, is that we've built the responsible equity. I think a lot of other fund managers, when they're mixed asset, think that they need to play with their weights, but actually we focus on building it responsibly. And I think And that means that like we can keep the equity risk on responsibly. And I like that thing. 2 years ago when we switched from a bit of S&P 500 to the S&P equal weight, the S&P equal weight outperforms the market cap weighted because it's a more prudent thing to do. And then and so there's less volatility, and it outperforms. So you're not just taking big risks in single stocks. And I think it's nice that over the long run, it's a bit more boring, but it outperforms. And I think that prudency, being prudent, pays in investment. And so you've got to just be prudent and be realistic and look at the volatility of things and looking how things are interacted and building the portfolio up and looking at your data and looking at the long-term data. And once you get a grasp of that, you can hopefully make good decisions. But most of those decisions are things happen. As Warren Buffett would say, he'd be buying equities even if World War III broke out, and because they are the best way to get your returns. But you've got to build that basket up responsibly, and that's why we talk so much about diversification.
And part of that is accommodating different views and ways of doing things in the team, which, again, Gary says back in 2023, makes it stronger.
Yeah.
So what's the dynamic
definitely
like between yourself
Yeah.
and the team as these events become more frequent?
Yeah.
Does it change the...
On the multi-asset funds, you're constantly trying to do the right thing for the fund, and everyone will make their case for a certain investment. But I mean, what's most important is that people see like that we can only take a certain amount of risk, and therefore what you're really spending is a risk budget. And when you get that in your head, that you will build that portfolio up responsibly, and we will do that in our asset allocation meetings. We'll be met with loads of data. And then also look at how funds are performing, and look at how the funds are performing, and what is doing those movements. But not just us, like that then gets looked over by compliance. It gets looked over by our depository. It gets looked over by senior managers. It gets looked over by the board. And we all have these things on top of it. So not only is that friction happening and making the right decisions in meetings, it gets so much bigger than that as well. So we have lots of people looking over it.
Well, Jake, congratulations again to you, to the team, to all the teams at Courtiers. Thank you to the clients, as Jake, as you rightly say. What matters most. What was the quote again? Remind us.
The customer's your only boss. You have the power to sack everyone in the company, but merely by shopping somewhere else.
So we better get back to work.
Yeah.
Jake, thanks very much for your time. I'm catching up with Gary next.
Yeah, thank you.
All right. If you have any questions, please do contact your advisor or get in touch through the website.